Saving for a down payment is one of the biggest challenges facing first-time homebuyers today. Trying to figure out how to save and still pay your regular expenses can be extremely complicated and discouraging. I mean, after all, you don't want to take years to save for a down payment only to see house prices continue to climb and get further out of reach. Well, there's two techniques that I'm going to teach you that you can use that will enable you to buy today, and this won't make your head spin. Well, here's strategy number one that we're going to talk about in this video. Get a loan or line of credit and combine this with a 5% cashback mortgage. That's right, combine it with a 5% cashback mortgage. Here's how it works. Let's assume you're going to buy a house for $250,000. You're required to put 5% for your down payment. So in this example, that's $12,500. So you're going to need a total mortgage of $237,500. But since you're putting less than 20% down, you're required to pay CMHC insurance fees, which is Canadian Mortgage and Housing. In this example, the cost is $7,481. The bank will loan you the money for that, add it onto your mortgage, so that's why you're going to need a total mortgage of $244,981. But remember, you don't have your down payment yet. So in this example, you're either going to take out a loan or line of credit. So what's the cost for that? Well, if you take out a loan, your loan payment's going to be $241 a month. Your line of credit payment will be $375 a month because it's based on a 3% payment on whatever amount that you've borrowed. So if you borrow $12,500, 3% is $375. So you're probably wondering, why should I even do this? Well, if you combine this with a 5% cashback mortgage strategy, this is how it works. The bank is going to give you 5% of your mortgage amount back in cashback. So in this example, they're going to give you $12,249. This money will be deposited into your bank account approximately 10 days after your house closes. Now, as soon as you have that money, you're going to use that to pay off your loan or line of credit depending on which one you have. Now you have no loan or line of credit payment, and essentially you bought a house with no down payment. This strategy has to be implemented at least 90 days before you begin your house search. Now, some key considerations: a 5% cashback mortgage will have a higher interest rate than a non-cashback mortgage, and typically the interest rate is approximately 1% higher. So let's calculate the cost. What is the difference? Well, a non-cashback mortgage is about $1,171 a month. A 5% cashback mortgage is $1,301 a month. So the difference is $130. So the question you need to ask yourself is, do I really want to pay $130 more every month to become a homeowner today, or should I continue to save until I have enough money? Well, why is this such a good strategy to use? Let's compare renting versus owning. So let's assume it's going to take you 5 years to save up $12,500. Now this is assuming you can save $208 every month for the next 60 months or 5 years. Now let's also assume that your monthly rent payment is $1,300. So over the next 5 years, you're going to pay your landlord $78,000 in rent payments. Now, if you own and take a cashback mortgage over 5 years, you're going to pay $78,000 in mortgage payments. So you have to weigh out whether it's better to pay that slightly higher interest rate for 5 years or to continue to save until you have your down payment while watching house prices continue to rise. You'll also be paying more towards your landlord's mortgage, which is really like throwing money away or dumping your piggy bank upside down and watching the money just go into water and become worthless. So let's take a look at a chart. So this is a chart of at the end of your term, so at the end of 5 years, what would your property value be worth? Well, based on a 3% price appreciation, your house would now be worth about $289,819. Now, remember, you only paid $250,000 for your house. Now, you've been making mortgage payments over the last 5 years, so your projected mortgage balance is going to be about $213,599. So you're going to have a combined equity of about $76,000. Where if you were just renting, you would have thrown away $78,000, but by taking a cashback mortgage, you're actually going to have a net worth of $76,000. Now, this is where it becomes even more exciting. Let's calculate what your house would be worth at the end of 25 years based on a value growth rate of 3%. Essentially, your property value would be projected to be worth $523,000. That's over $500,000. And you would have your mortgage completely paid off. Fortunately, there's a no-cost alternative to guide you along the way so you could implement this strategy and own a home today and see whether this is right for you. By using a mortgage advisor, you'll have a seasoned professional on your side to provide you the information and guidance you need to make the most cost-effective decision. As your trusted mortgage advisor, I'll analyze your needs, then I'll help you choose the rate, term, amortization, and down payment option that is best suited for you and your family. Since I work for the bank, I could arrange your loan or line of credit too. I'm committed to help homeowners become fully informed and qualified before they start shopping for a home. So what I'd like to do is offer you a complimentary, no obligation information session so you could learn more about this strategy and see if you qualify to take advantage of this program. I'll answer all your questions and help you become a homeowner today. Give me a call. I can be reached at 866-247-1378 or by email at tim.shwed@cibc.com. And here's to your success in buying your first home.